Hello and welcome. I'm Andrew Carrier and I head marketing at Dolfin. I'm joined today by our Chief Investment Officer, Vassilis Papaioannou. Vassilis, thank you for joining us.
Good morning, Andrew.
Good morning. Your team has just published its March investment update, and I wondered if we could just start by you giving us an overview of the key views from that.
Of course. For March, we turned a little bit neutral and more cautious when it comes to our previously risk-on mode. We turned neutral on rates, although we remain on a bearish mode. Within credit and particularly investment grade, we like the space currently. We're more cautious on high yield as it has these equity-like characteristics. Within equities, we still favor the asset class, but we're a little bit more cautious given what happened in February. We maintain our strong bias for Europe and Eurozone in particular. And when it comes to currencies, we still do not like the US dollar.
So we had a little bit of drama after the filming of our last video. You just finished telling me on camera how positive you were about equities, and we got back to our desks and almost immediately saw some significant volatility on equities markets worldwide. Now that we've had a chance to stop and catch our breath, I just wondered if you could give us a take on what happened.
It was a reminder that equity markets can be volatile. The long-awaited rise in volatility. From a technical perspective and what happened, it was a technical correction. Technical correction means 10% drop from peak to trough. The trigger point was elevated wage growth in the US, so anxiety around rising inflation expectations and rising rates, which could harm already stretched valuations. So all in all, we had this drop. The market bounced around the 200-day moving average, and we had, in most markets, this V-shaped recovery.
So your team rightly called that V-shaped recovery. What I'm wondering now is what happens next?
It's very important for investors to assess the medium-term outlook by considering what happens now. And obviously, the technical correction took place. That is done. The question is, March will be a very important and decisive month. We have Trump announcing tariffs on the one side, and on the other side, we have limited options for investors to express their anxiety. So obviously, the tariff story puts question mark on the global growth and narrative, and also intensifies that anxiety about global trade wars. And when I mentioned obviously how investors can express that anxiety, gold it's not currently a place to be because the Fed is hiking and due to this hawkish stance, US Treasuries and government bonds yields and real yields are quite low, so it's not very effective. The US dollar, as a result of tariffs and in general the isolationist policy, it's not a good place to be. So all in all, investors need to be more on the sidelines. They need to raise more cash as possible and focus on either low correlated themes or high conviction themes.
So we saw the dollar jump this week off the back of comments that Jay Powell had made to Congress. He was hinting at some rate rises this year. He's chairing his first Fed meeting this month. What do you think we're likely to get from that?
It's very important what Chairman Powell is saying. During the testimony, he hinted on 4 hikes, which was new information into the market perceptions. For the March meeting, the hike is almost 90% priced in. But the main takeaway from Powell's testimony was the trade-off between the number of hikes and the yield on the long end of the curve. So as long as we have a little bit more inflation, as long as the economic backdrop remains strong, we can tolerate and we can accept 4 hikes in the US, and we can even have a 4% yield on the 10-year, but we need to remain on that strong global growth path.
So I'm always fascinated by your team's investment ideas that you produce regularly. You still have one out about being positive on European equities. Could you tell us a bit more about why it is that you've singled out European equities?
We continue to favor European equities and Eurozone in particular for 4 reasons. First, valuations. The valuations are not excessive on a relative and absolute base. Second reason is the continued accommodative monetary policy by the ECB and Mario Draghi. The third point is obviously slack in the unemployment labor market. So unemployment currently in Europe is around 8.5. So there's a lot of room for unemployment to come down, and with significant implications on the consumer spending side. And fourth, most importantly, we have a synchronized European economic recovery. So it's not just the core that has been rebounding, it's just also the periphery. So all member states are rebounding strongly, and this is a good place to be.
And do you favour particular sectors in Europe?
We continue to favour consumer, we continue to favour banks, energy and technology.
Vassilis, thank you for joining us. Some really interesting insights, as always, from you and your team.
Thank you, Andrew.
And thank you for joining us. Please do visit our website to download your copy of our March investment update, and we look forward to seeing you in our next video.